This is Terrence Andre Banks with Information Age Financial Solutions, coming to you today from great article I read from Mish Talk. Housing liquidity crisis coming, debt deflation follows. Real estate is a primary factor of wealth for most Americans and a lot of different people worldwide. And with the recent updates in terms of housing itself and the recent interest rates, that the warning for that, it's always a good idea to keep abreast of that. Now, always want to remind you, in Information Age Financials, when crashes happens, it actually means an opportunity for you to buy. So although it's saying like doom and gloom here, it's just something to keep abreast of, because when opportunities like this, which crashes usually do happen every 4 to 8 years, or throughout the history of the Republic, we're in the longest economic expansion, second longest economic expansion in U.S. history. It's always been to be mindful of that we're coming to the end. We're coming to the end where it cannot continue to grow without any corrections, but so much longer. And especially with real estate, because just the increase in real interest rates is always something to be mindful of. This article is pretty lengthy in time. I want to get right into it and go right in. A liquidity crisis in housing is on the way. Non-banks are at the center of the storm. The Brookings Institute says a liquidity crisis in the mortgage market is on the way. This is a guest post format. What follows are key snips from a 68-page Brookings PDF. This article isn't very long. My comments follow. Abstract. Non-banks originated about half of all mortgages in 2016 and 75% of mortgages in the FHA or VA loans. Both shares are much higher than those observed at any point in the 2000s. We described this in paper how non-bank mortgage companies are vulnerable to liquidity pressures in both their loan origination and serving activities, and we document that the sector in aggregate appears to have minimal resources to bring to bear in a stress scenario. So essentially what he's trying to get here, that they don't have enough cash to run themselves into a financial issue, which means liquidity just means another term for ability to access cash and have it. How liquid can it be? Can it be able to convert it? Can it be able to sell? Just wanted to point that out. We show how that these same liquidity issues unfolded during the financial crisis, leading to the failure of many non-bank companies, requests for government assistance, and harm to consumers. The extremely high share of non-bank lenders in FHA and VA lending suggests that non-bank failures could be quite costly to the government, but the issue has received very little attention in the housing reform debate. It's not going to get that much attention because, again, housing is where, what they're hoping to bank this on. People use the houses, again, as a form of, not just a form of living or at the American standard, they also utilize it as their main source of what they consider to be wealth. And these are not investors here. We're just talking about regular people. There's now considerable stress on Ginnie Mae operations from their non-bank counterparties. Today, almost 2/3 of Ginnie Mae guaranteed securities are issued by independent mortgage banks. And independent mortgage bankers are using some of the most sophisticated financial engineering that industry has ever seen. They never seem to learn, even though we've had a crash in 2008, and it started because of subprime at that point with these exotic loan instruments. It's the game continues and plays again. So deja vu is right about to happen. We're also seeing greater dependence on credit lines, securitization involving multiple players, and more frequent trading of service rights. And all these things have created a new challenging environment for Ginnie Mae. In other words, the risk is a lot higher, and the business models of our issuers are a lot more complex. And add in simply higher annual volumes, and these risks are amplified many times over. Also, we have depended on sheer luck. I'm telling you. Luck that the economy does not fall into recession, increase mortgage delinquencies. Luck that our independent mortgage bankers remain able to access their lines of credit. And luck that nothing critical falls through the cracks. Non-bank shares in billions. And they're showing this just skyrocket. Again, this is recent news that they said used in 2016 in terms of these loans. Although both the GSE and Ginnie Mae guaranteed mortgage-backed securities, there are a number of essential differences. In particular, Ginnie Mae services are exposed to greater liquidity strains and a greater risk of absorbing credit loss than GSE services, guaranteeing issuance of securities. Guaranteeing issuance of securities, both the GSEs and Ginnie Mae provide a guarantee to their mortgage-backed securities, MBS investors, that they will receive their payments in interest and principal on time. One crucial difference between these institutions, though, is who issues the underlying securities. The GSE purchased loans from mortgage originators and issued securities themselves for Ginnie Mae MBS financial institutions. Originate or purchase mortgages and then issue securities from the Ginnie Mae platform. In both cases, the loans and the securities had to meet certain underwriting standards and other requirements. The GSEs are to set the standards for loans in their pools. For Ginnie Mae pools, the standards are set by the government agency that provides insurance or guarantee on the mortgage. Federal Housing Administration, Veterans Administration, Farm Service Agencies, giving examples here, Rural House Service, or Office of Public and Indian Housing. Assurance against credit risk. Another crucial difference between the GSE and the Ginnie Mae is who bears the credit risk associated with the mortgage default. As shown in Figure 3, for loans in GSE pools, the mortgage borrower takes the initial credit loans in the form of her equity in the house, followed by the private mortgage insurance PMI company if the mortgage has PMI, and then the GSE. For loans in Ginnie Mae pools, the mortgage borrower is again in the first loss position, followed by the government entity that guarantees or insures the loans. However, the Ginnie Mae issuer servicer, unlike in the GSE case, is expected to bear any credit losses that the government issuer does not cover. Now that's something interesting. Ginnie Mae covers credit losses only when the corporate resources of the issuer services are exhausted. Well, we're seeing here that they are lacking that liquidity. Look at the servicing strains, and they're showing this little chart. I love charts here. Last loss, first loss, and they're showing here the first the home equity loaner, then the FHA, then the capital insurance, then the Ginnie Mae and GSEs here. But look at the concentration of where these loans are at. And there's so many different areas. Figure 12 above shows a share of all mortgages in 2016 that were originated by non-banks and insured by FHA or VA. Servicers with heavy concentrations may be more vulnerable to serving advanced strains. Consequences of a non-bank mortgage company failure. In the event of a failure of a non-bank mortgage company, there are three main types of parties who will bear losses. Here we go. This is pointing them out for you. Consumers. 2, the U.S. government and by extension taxpayers. 3, the non-banks, their shareholders and their creditors. If non-bank failure resulted in a reduction in mortgage origination capacity, it is not clear that other financial institutions will extend credit on the same terms to these borrowers. This is very important here. If non-bank failure resulted in a reduction in mortgage origination capacity, it is not clear that other financial institutions would extend credit on the same terms to these borrowers, or perhaps even extend credit at all. Sounds like a systemic crisis, crash ready to happen with this. This contraction in mortgage credit availability has the potential to be a significant drag on housing prices. Essentially, with that not being said, housing prices will decrease. So people who bought houses, and imagine you purchase a house in the last couple of years and only to find that you overpriced it. You found yourself in the housing prices and your deflation happens and your housing value goes down. And if you're borrowing on that, or hoping that that appreciation comes, you're even in a worse situation because you're now in a situation you're upside down again. This has happened before, and we don't seem to learn from history. That's why I'm definitely pointing this out, especially for the information age. It definitely presents an opportunity for you if you're on the right side of this, and if you're patient and seeing how this thing is going to play out. The Brookings article is 68 pages long. The above snips capture the essence of their liquidity crisis claim, but they provide much more detail. Shocks coming. Non-banks are vulnerable to macroeconomic shocks, rising interest rates, home prices declines, and job losses, often with a bare minimum down payment. Very important here. This is happening while debt-to-income ratios are on the rise and median FICO scores are dropping because we are taking on so much more debt. People continue using credit card binges as well. And we're all into this. We're all in. You're not gonna be isolated. That's why this channel that I created is such important that you get the information about that. This is hard surprising. Given homes are not affordable. Let me repeat that again. I didn't do a good job reading that. This is happening while debt-to-income ratios are on the rise and median FICO scores are dropping. This is hardly surprising given homes are not affordable. They aren't affordable. Failure is a given. Brookings provides a failure. I can't even say the word. Hierarchy and failure is a given. To keep the latest bubble going, non-banks kept lowering and lowering credit standards as home prices kept rising and rising. Same game as before. That is a recipe for disaster, and disaster is at hand. Housing collapse coming. 4 days ago, before I saw the Brookings article, commented, housing collapse coming right up. The Brookings article reinforces my opinion. Meanwhile, overdue debt is at a year high. Distressed debt surged 11.5% in the fourth quarter. The Financial Times also notes more Americans are also falling behind on their mortgages, for which problematic debt levels rose from 5.2% over the same period to $56.7 billion. Deflationary debt trap set up. These numbers are huge deflationary. When credit expands, there's inflation. When credit contracts, think defaults, bankruptcy, mortgage, walkaway events, debt deflation occurs. Here's my definition of inflation: an increase in money supply and credit with credit mark to market. Deflation is the opposite: a decrease in money supply and credit with credit mark to market. Looking ahead, credit card delinquencies are priced as if they would be paid back. They won't. Good. I love these points here. As soon as recession hits, defaults and charge-offs will mount. In turn, this will reduce the amounts banks will be willing to lend. Subprime corporations will have been borrowing money quarter after quarter, will find they are priced out of market, unable to roll over their debt. In a fiat credit-based global setup, this is how the real world works. Unanimous opinions. Seldom are opinions nearly unanimous. This is one of those times. Nearly everyone is looking for inflation. We have it. It is in home prices, junk bond prices, and equity prices. Again, if you're anything involved in real estate, I am, and you go to real estate meetings, you will see things that doesn't make any financial sense, especially for rentals or even housing prices, even in your area, when you know that they're inflated because you know the job market, and you'll constantly see that because they're hoping that the price of inflation is coming. He's pointing this out. The equity bubble is about to burst. For discussion, please see Sucker Traps and the Arithmetic of Risk. I like these titles here. And he shows a stealth age and then the despair that comes over here. Love charts. We have so much inflation that inflation is in the rearview mirror. Inflation economists expect to happen. Already has happened in stocks and home prices and junk bonds. So everybody's hoping for inflation to come, and they don't realize that it's already happened. That's what he's getting at here. But what he's pointing into is where everyone really needs to pay: debt deflation coming up. I expect another round of asset-based deflation with consumer prices and U.S. Treasury yields to follow. You heard it here, folks. If this has been any value to you, please subscribe, leave some comments. Be mindful of what's going on. If you're looking to purchase a home, it may not be the best time. And even though I know the media picks on here, the interest rates will continue to rise. But with this information here, that means it may be a greater opportunity for to buy a home at a price that's cheaper, and you get more equity for your buck. And remember, homes are places for you to live at. And speculation and risk, and putting it that sometimes it's better just to hold your cards and be patient. So until my next video, I'm out.